There was a time when the American dream meant something different. It meant a house with a white picket fence, a steady job with a pension, a car in the driveway, and the promise that your children would have it better than you did. But somewhere along the way, that dream was bought, repackaged, and sold back to us at interest. This is the story of how Wall Street didn't just participate in the American economy. It consumed it, rewrote it, and made us all players in a game most of us never understood we were playing. The year is 1945. The Second World War has just ended, and America stands as the last industrial power left standing. Europe is in ruins, Asia is devastated, but American factories are humming. American banks are flush with capital, and millions of young men are coming home, ready to build lives. The GI Bill promises them education, home loans, and a pathway to the middle class. This is the moment when the traditional American dream is born, not as an idea, but as a tangible reality made possible by government investment and industrial wages. A factory worker at General Motors could buy a home, support a family on a single income, and retire with dignity. Wall Street existed, of course, but it was a distant entity, something for the wealthy, for the elite. The average American never thought about stocks or bonds or financial markets. They thought about paychecks and savings accounts. But even then, the seeds were being planted. The Employment Act of 1946 created the Council of Economic Advisors and committed the federal government to promoting maximum employment and production. It was a noble goal, but it also signaled a shift. The government was now intimately involved in managing economic outcomes, and where government attention goes, financial power follows. Wall Street began to see opportunity, not just in trading stocks or underwriting bonds, but in shaping policy itself. The financial sector started hiring economists, former Treasury officials, people who understood the levers of power. They started building relationships with Congress, with regulatory agencies, with the Federal Reserve. It was subtle at first, almost invisible, but the foundations were being laid for what would come. The 1950s and 60s were the golden age of American capitalism, or so the story goes. Wages rose steadily, productivity increased, the middle class expanded, corporations offered pensions and health insurance, unions were strong enough to negotiate for workers but not so powerful as to threaten profits. It seemed like a stable equilibrium, a system that worked for everyone. But beneath the surface, tensions were building. Inflation began creeping up. The Bretton Woods system, which had pegged global currencies to the dollar and the dollar to gold, started showing cracks. American companies faced new competition from rebuilt economies in Japan and Germany, and Wall Street, which had been relatively quiet since the Great Depression and the regulations that followed, started getting restless. The first major crack came in 1971, when President Nixon closed the gold window, effectively ending the Bretton Woods system. Suddenly, the dollar was no longer backed by gold, it was backed by faith, by the full faith and credit of the United States government. This was a seismic shift, though few Americans understood it at the time. What it meant was that money itself had become more abstract, more flexible, more manipulatable. And when money becomes abstract, Wall Street thrives. Currency trading exploded, foreign exchange markets became massive, and the financial sector began to grow not just in absolute terms, but as a percentage of the entire economy. In 1950, the financial sector accounted for roughly 2.5% of GDP. By the early 2000s, it would be over 8%. That growth had to come from somewhere. It came from the real economy, from manufacturing, from wages, from the pockets of ordinary Americans.
The 1970s were a decade of crisis. Stagflation, the combination of stagnant growth and high inflation, baffled economists who thought such a thing was impossible. Oil shocks sent gas prices soaring, unemployment rose, faith in institutions crumbled after Vietnam and Watergate. The post-war consensus was breaking down, and into that vacuum stepped a new ideology. It had many names: free market capitalism, neoliberalism, Reaganomics. But at its core, it was simple. Government was the problem, not the solution. Regulation stifled innovation. Taxes punished success. The market, left to its own devices, would produce optimal outcomes for everyone. It was a seductive message, especially after a decade of malaise. And Wall Street loved it because it meant fewer rules, lower taxes, and more opportunities to make money. Ronald Reagan's election in 1980 marked the beginning of a revolution, though it was packaged as a return to traditional values. Taxes on the wealthy were slashed. The top marginal rate, which had been 70%, eventually dropped to 28%. The theory was that this would stimulate investment and growth, that the benefits would trickle down to everyone. But what actually happened was that the wealthy got wealthier and Wall Street got more powerful. Deregulation became the watchword. The financial sector, which had been tightly controlled since the Great Depression, was slowly unleashed. In 1982, the Garn-St. Germain Depository Institutions Act deregulated savings and loan associations, allowing them to engage in risky lending. Within a few years, hundreds of them had failed, costing taxpayers over $100 billion. It was a preview of what to come, but the lesson wasn't learned. The lesson Wall Street took was that risk could be rewarded and losses could be socialized. But the real transformation was more subtle than any single policy change. It was cultural. It was psychological. Wall Street began to sell a new version of the American dream. The old dream was about security, about stability, about building something solid that you could pass on to your children. The new dream was about wealth, about getting rich, about beating the market. Television shows celebrated traders and deal-makers. Movies like Wall Street glamorized greed. Gordon Gekko's infamous line, "Greed is good," was meant to be a critique, but many took it as inspiration. Business schools exploded in popularity. The brightest minds of a generation, people who might have become engineers or scientists or teachers, flocked to finance. And why wouldn't they? A fresh MBA graduate could make more money in their first year on Wall Street than a teacher would make in 5. The incentives were clear and they were powerful. The 1980s also saw the rise of the leveraged buyout, the hostile takeover, the corporate raid. Private equity firms would borrow enormous sums of money to buy companies, strip them of assets, load them with debt, and sell off the pieces for profit. Workers lost jobs, pensions were raided, but shareholders made money, and executives got golden parachutes. This was celebrated as creative destruction, as capitalism at its most dynamic. The human cost was mentioned, if at all, as an unfortunate but necessary side effect. Wall Street had discovered that you could make money not by building things, but by rearranging them, by financial engineering, by playing with numbers on a spreadsheet. Production became less important than extraction.
In the 1990s, the process accelerated. The Cold War ended and capitalism seemed triumphant. Francis Fukuyama declared the end of history. Markets were the answer to everything. The internet boom created a sense of unlimited possibility. Anyone could get rich if they just picked the right tech stock. Day trading became a hobby for millions of Americans. The old model of investing, buying solid companies and holding them for decades, seemed quaint. The new model was about momentum, about getting in early and getting out before the bubble burst. And Wall Street was happy to facilitate this because every trade generated fees. The more people traded, the more money Wall Street made, regardless of whether those people actually profited. Then came the repeal of Glass-Steagall in 1999. This Depression-era law had separated commercial banking from investment banking, preventing banks that held people's deposits from engaging in risky speculation. Its repeal was the result of years of lobbying by the financial industry, and it was sold as modernization, as necessary to keep American banks competitive in a global economy. President Clinton signed it with bipartisan support. Almost no one seemed to notice or care that the firewall between Main Street and Wall Street had just been demolished. Within a few years, banks became too big to fail. Massive institutions that combined retail banking, investment banking, insurance, and everything in between. They had become systemic risks, institutions whose failure would threaten the entire economy. And they knew it, which meant they could take enormous risks, secure in the knowledge that if things went wrong, the government would have no choice but to bail them out. The 2000s brought the ultimate expression of Wall Street's power, the housing bubble. Homeownership had always been central to the American dream. A home was security, an investment, a place to raise a family. But Wall Street saw something else. They saw cash flows that could be packaged, sliced, and sold. Mortgages became securities. Securities became derivatives. Derivatives became so complex that even the people creating them didn't fully understand them. Subprime lending exploded. People who could never afford homes under traditional lending standards were suddenly approved for massive loans with adjustable rates and hidden fees. Predatory lenders targeted minority communities, the elderly, anyone vulnerable. It didn't matter if the borrower could actually pay back the loan, because the lender wasn't holding the loan. They were selling it to Wall Street, which was bundling it with thousands of other loans and selling it to investors as a supposedly safe investment. Rating agencies, which were supposed to independently assess the risk of these securities, gave them top ratings. Why? Because the agencies were paid by the very banks whose products they were rating. It was a conflict of interest so blatant it would be comical, if the consequences hadn't been so devastating. Everyone was making money. Real estate agents, mortgage brokers, banks, rating agencies, investors. The only people who would ultimately lose were the homeowners who couldn't afford the mortgages they'd been sold, and the taxpayers who would be forced to clean up the mess. But that was in the future, and in finance, the future can always be discounted. Housing prices soared. People began to think of their homes not as places to live, but as investments, as ATMs they could continuously refinance to pull out equity. Household debt skyrocketed, savings rates plummeted. But it felt like prosperity. People were living in bigger houses, driving nicer cars, taking expensive vacations, all financed by debt. And Wall Street cheered, because debt was their product. Every mortgage, every credit card balance, every car loan was an asset on someone's balance sheet, generating returns for investors. The average American had been turned into a profit center, and they didn't even realize it. Then it all came crashing down. The year 2008 will be remembered as one of the darkest moments in American economic history. Bear Stearns collapsed in March. Lehman Brothers filed for bankruptcy in September. AIG, one of the largest insurance companies in the world, had to be bailed out. The stock market lost half its value. Home prices plummeted. Millions of Americans lost their homes to foreclosure. Unemployment soared. Retirement accounts were devastated. A lifetime of savings vanished in months. The American dream, the promise that if you worked hard and played by the rules, you could build a secure life, shattered for millions of people. And what happened to Wall Street? The big banks were bailed out. The government committed trillions of dollars to stabilizing the financial system. It was necessary, we were told, because the alternative was complete economic collapse. And maybe that's true. But the inequity was stark and undeniable. Homeowners who had been sold predatory loans got no bailout. They lost their homes, but the banks that had created those loans, that had packaged them into toxic securities, that had crashed the global economy through greed and recklessness, they got rescued. Profits had been privatized, but losses were socialized. It was socialism for the rich, capitalism for everyone else. In the aftermath, there was talk of reform, of holding people accountable, of making sure this could never happen again. The Dodd-Frank Act was passed, creating new regulations and a Consumer Protection Bureau. But the financial industry immediately began working to weaken it, lobbying Congress, challenging it in courts, death by 1,000 cuts. And not a single major Wall Street executive went to jail. Not one. Some banks paid fines, but those fines were a tiny fraction of the profits they'd made and a pittance compared to the damage they'd caused. The message was clear. Wall Street was above the law. too big to fail meant too big to jail. The recovery that followed was the most unequal in American history. The stock market came roaring back, reaching new highs. Corporate profits soared, but wages for ordinary workers stagnated. The gains from the recovery went almost entirely to the top 10%, and especially to the top 1%. Home ownership rates declined, millennials graduated into the worst job market in generations, burdened with student loan debt that couldn't be discharged in bankruptcy. The gig economy replaced stable employment, benefits disappeared. The 40-hour work week became a relic. People worked multiple jobs just to survive. The middle class, which had been the foundation of the American dream, hollowed out. You were either winning big or struggling to get by, with less and less in between. And through it all, Wall Street kept growing. High-frequency trading, conducted by algorithms in microseconds, came to dominate markets. Private equity bought up everything from retail chains to nursing homes, loading them with debt and cutting costs to maximize returns. Hedge funds became kingmakers, able to move markets with their bets. Wealth inequality reached levels not seen since the Gilded Age. The richest 400 Americans had more wealth than the bottom 60% combined. And much of that wealth was tied to financial assets, to stocks and bonds and derivatives, disconnected from any productive activity. The financialization of the economy became complete. Everything became an asset class. Housing, education, healthcare, even water rights. Everything could be bought, sold, and traded. Wall Street found ways to profit from student loans, from medical debt, from municipal bankruptcy. Pension funds, trying to meet their obligations, were pushed into riskier and riskier investments. Everyday Americans, through their 401k plans, became dependent on the stock market for retirement, tying their futures to the very institutions that had crashed the economy. It was brilliant in its way, a system where everyone was complicit. Everyone had a stake in keeping the machine running, even as it ground people into dust. Politics became thoroughly financialized as well. The Supreme Court's Citizens United decision opened the floodgates for unlimited political spending. Wall Street poured money into campaigns, into lobbying, into think tanks and advocacy groups. They didn't just buy politicians, though they did that too. They bought the entire ecosystem of ideas, shaping what was considered serious policy, what was realistic, what was possible. Both parties became dependent on Wall Street money. Regulations were written by industry lobbyists. Enforcement agencies were starved of resources or captured by the industries they were supposed to regulate. The revolving door between Wall Street and government spun faster and faster. Treasury secretaries came from Goldman Sachs and went back to Goldman Sachs. The interests of the financial sector and the interests of the nation became indistinguishable in the minds of policymakers. Social media and technology created new frontiers for Wall Street. Companies that had never turned a profit commanded billion-dollar valuations. Venture capital poured money into startups with the hope that 1 in 10 would become a unicorn, a company worth over $1 billion. It didn't matter if the business model made sense. It mattered if you could sell the story, if you could attract users, if you could dominate a market. Uber, WeWork, Theranos, the stories were different, but the pattern was the same. Promise disruption, raise massive amounts of capital, grow at all costs, worry about profits later. Some succeeded, most failed, but the venture capitalists and early investors usually made money regardless because they got out before the collapse. Once again, risk and reward were disconnected. The people taking the risks, the workers and the late investors, bore the losses. The insiders walked away rich. Cryptocurrency and blockchain were sold as a way to escape Wall Street's control, to create a decentralized financial system beyond the reach of banks and governments. But Wall Street simply absorbed it. Major banks started offering crypto trading. Investment funds bought Bitcoin. The same boom and bust cycles, the same speculation, the same hype and manipulation. It all just moved to a new arena. The technology changed, but the game remained the same. Those with capital and information advantage profited. Everyone else took the risks. The pandemic of 2020 exposed just how fragile the system had become. Millions lost their jobs overnight. Food banks had lines stretching for miles. Small businesses closed permanently. But the stock market, after a brief dip, soared to record highs. How was this possible when the real economy was in crisis? Because the Federal Reserve flooded the system with money, buying bonds and keeping interest rates at zero to prevent financial collapse. That money was supposed to flow into the real economy, but much of it ended up in financial markets, inflating asset prices. If you owned a stock, if you owned a home, you got wealthier. If you lived paycheck to paycheck, you fell further behind. The pandemic stimulus included direct payments to individuals and expanded unemployment benefits, and these helped millions survive. But they were temporary and fought at every step, while the support for financial markets was massive and immediate and unquestioned.
Storytelling friendly. The meme stock phenomenon of 2021, when retail investors organized on Reddit to drive up the price of GameStop and other struggling companies, was seen by some as a rebellion against Wall Street. And in a way, it was. It was ordinary people realizing they could, at least briefly, play the same games the hedge funds played, inflicting losses on short sellers who had bet against these companies. But ultimately, Wall Street adapted. Robinhood, the app that had democratized trading, restricted buying at a crucial moment, protecting the institutional players. The little guy got a small win, but the structure of power remained unchanged. If anything, it just drove more people into trading, generating more fees, creating more volatility that sophisticated algorithms could exploit. Today, the American dream that Wall Street sold us looks very different from the one that existed 80 years ago. It's not about security or stability. It's about hustle culture, about side gigs, about investing wisely, about making your money work for you. We're all told to be entrepreneurs, to think of ourselves as brands, to optimize and maximize and leverage. But this is exhausting. It puts all the risk on individuals. If you succeed, it's because you worked hard and made smart choices. If you fail, it's your fault. You should have learned to code. You should have invested better. You should have been more resilient. The systemic forces, the rigged game, the fact that Wall Street has stacked the deck, that gets ignored. Homeownership, once the cornerstone of the American dream, is increasingly out of reach for young people. Private equity firms buy up housing stock, turning single-family homes into rentals. Prices in major cities are astronomical. Even with a good job, saving for a down payment can take years or decades. Student loan debt delays marriage, delays having children, delays every major life milestone. Healthcare costs can bankrupt you even with insurance. Retirement seems like a distant fantasy when you're struggling to make rent. The dream now is just to keep your head above water, to avoid catastrophe, to maybe, if you're lucky and smart and work incredibly hard and nothing goes wrong, achieve a modest level of comfort. That's not a dream. That's survival. And calling it a dream is an insult to everyone who's living it. Wall Street didn't destroy the American dream through some grand conspiracy. There were no shadowy figures in smoke-filled rooms plotting the downfall of the middle class. It was more banal than that. It was incentives and opportunities and the logic of capital. Money flows to where it can make more money. Power accumulates where it can protect and expand itself. Wall Street simply did what it was designed to do. It maximized profits for shareholders, it minimized risk for itself, it innovated in ways that concentrated wealth and power, and it convinced us that this was not only inevitable, but good.
We were told that a rising tide lifts all boats, but it turns out some people have yachts and some people are drowning. We were told that the market is efficient, that it allocates resources optimally. But efficient for whom? We were told that everyone could win. But the game was designed so that only some could win. And they would win so big that everyone else's losses wouldn't matter to the overall numbers. GDP could grow while median wages stagnated. Corporate profits could soar while workers lost benefits. The stock market could hit records while homelessness increased. These contradictions were papered over with debt and rhetoric until they couldn't be anymore. The question now is what comes next? Can the system be reformed, or does it need to be rebuilt? There are no easy answers. The problems are structural, built into the foundations of how we've organized our economy. Incremental changes might help at the margins, but they won't address the fundamental imbalance of power. Wall Street has capital. It has political influence. It has the best lawyers and accountants and lobbyists. It shapes the rules of the game. And as long as that's true, any reforms will be watered down, circumvented, or reversed. Some argue for breaking up the big banks, for restoring Glass-Steagall, for much higher taxes on financial transactions and extreme wealth. Others want public banking options, worker ownership, a guaranteed jobs program, universal basic services. Still others believe the system is beyond reform and advocate for more radical transformation. These debates are important, and they're finally happening more openly than they have in decades. The consensus that markets know best, that what's good for Wall Street is good for America, that consensus is breaking down. But change is hard, and it's slow, and it requires sustained political will, which is difficult to maintain when the other side has unlimited resources. Wall Street doesn't need to win the argument. It just needs to delay, to confuse, to divide, to wait for attention to move elsewhere. And it's very good at that. What's undeniable is that millions of Americans feel betrayed. They did everything right. They went to school, they worked hard, they saved when they could, and still they're falling behind. Still they're one medical emergency or car breakdown away from financial disaster. They look at Wall Street bonuses and bailouts and feel, rightly, that the game is rigged. That sense of betrayal is dangerous. It breeds cynicism, anger, desperation. It tears at the social fabric. It makes people susceptible to demagogues and simple solutions to complex problems. The American dream was always partly myth, partly aspiration. It was never equally available to everyone. Race and class and geography always mattered, but there was enough truth in it, enough real examples of mobility and security that people believed. That belief is dying. And when people stop believing in the dream, when they stop believing the system can work for them, they start looking for alternatives, for something, anything different. Wall Street bought the American dream, not with a single transaction, but with a million small ones, each seemingly reasonable in isolation. A deregulation here, a tax cut there, a bailout when needed, a lobbying campaign, a campaign contribution, a revolving door appointment, death by 1,000 cuts, or perhaps more accurately, purchased by 1,000 contracts. And what they bought wasn't just economic assets, but something more fundamental. They bought the idea that life is a market, that everything has a price, that we are all just rational actors maximizing our utility, that there is no society, only individuals competing.
This is the deepest damage, the cultural and psychological transformation. We've internalized Wall Street's values even as Wall Street has taken our wealth. We measure our worth by our net worth. We see other people as competition or resources. We think of ourselves as investments that need to yield returns. The language of finance has colonized how we think about everything. We talk about social capital and investing in relationships and the marketplace of ideas. Even resistance gets packaged and sold back to us as a brand. But here's what Wall Street can never buy, no matter how much money it has. It can't buy meaning. It can't buy solidarity. It can't buy the human desire for dignity and justice and community. Numbers on a screen, no matter how large, are ultimately abstractions. What matters is the lived experience of real people in the real world. Can they feed their families? Can they see a doctor when they're sick? Can they give their children opportunities? Can they retire without fear? Can they participate in decisions that affect their lives? These are the questions that matter, and these are the questions that a system obsessed with maximizing shareholder value cannot answer. The American dream that Wall Street bought and sold was always too narrow, too focused on individual material success. Maybe what we need is a different dream, a collective dream, one that measures success not by how much any individual can accumulate, but by how well we take care of each other. A dream where security is a right, not something you have to earn or win. Where healthcare and education and housing are public goods, not profit opportunities. Where work is valued and fairly compensated. Where the economy serves people, not the other way around. This might sound naive or utopian, especially after witnessing the power and resilience of Wall Street. But what's truly naive is believing that the current system can continue indefinitely, that inequality can keep growing, that people will keep accepting a raw deal, that there won't be consequences. Every system has limits. Every concentration of power eventually produces a countervailing force. It might take years or decades, but change will come. It always does. The story of how Wall Street bought the American dream is not over. It's still being written. We are living through its latest chapters, and what happens next depends on choices we make collectively. Do we accept the world that Wall Street has built, or do we imagine and fight for something different? Do we let capital continue to reshape society in its image, or do we reclaim democratic control over our economic life? Do we remain passive consumers and workers and voters, or do we become active citizens demanding a system that works for everyone? These aren't just political questions, they're moral questions about what kind of people we want to be, what kind of society we want to live in, and what kind of world we want to leave to those who come after us. Wall Street offers one answer, the answer of markets and competition and individual striving. But there are other answers, rooted in cooperation and solidarity and collective provision. Which answer prevails will determine not just the shape of the American dream, but whether that dream, in any meaningful form, survives at all. In the end, what Wall Street bought was never really theirs to sell. The American dream belongs to the people who live it, who work for it, who believe in it. It can be stolen or corrupted or betrayed, but it can't be permanently destroyed. As long as people hunger for justice, for dignity, for a better life, the dream persists. Wall Street's purchase isn't final. It's just the current state of a much longer struggle, one that has defined American history from the beginning. The struggle between those who have and those who don't, between concentrated power and democratic aspiration, between the logic of markets and the needs of human beings. The trading floor will open again tomorrow. The tickers will flash. The algorithms will execute millions of trades in microseconds. Money will be made and lost, fortunes created and destroyed. And all of it will seem very important, very urgent, very real. But step back far enough, and you can see it for what it is. A game. A very consequential game with real winners and real losers, but still a game, with rules that were written by those who benefit from them. And rules can be changed. They have been changed before, and they will be changed again. The only question is when and how, and whether the change comes through reform or through collapse, through deliberate choice or through crisis. How Wall Street bought the American dream is a story of power and money, of greed and ambition, of brilliant innovation put toward narrow ends, of a system that privatized gains and socialized losses, of promises broken and trust betrayed. But it's also a story that isn't over, a story whose ending we still have the power to shape, if we can find the courage and solidarity to do so. The dream isn't dead. It's been hijacked, financialized, commodified. But the human longing it represents, the desire for security and opportunity and fairness, that can't be bought or sold. That belongs to us. It always has. And maybe, just maybe, it always will.